investment event, and I'm delighted to have James Fallows, Senior Investment Strategist of Vestra Wealth, as our speaker today. James has acquired exceptional knowledge and expertise of the current investment climate and will now speak to you about these.
Hello, my thanks to Natasha and to Insight for inviting me here today. The title of my talk, In a Complex World, It's Hard to Argue Against a Focused Approach, sums up a number of very simple but important kind of themes. In essence, my talk is directed at savers who, whilst being tempted to sit on cash that they worked hard to provide for, cash that they think will sustain them through their retirement years, need to be aware of some very salient facts. Number one being inflation, which has a very insidious effect on the rate on savings. It chews away at the purchasing power of money, and the compound effects can be quite damaging in time. And sadly, interest rates fail to compensate for the risks involved. Now, there are popular alternatives out there. Number one is index-linked bonds. Many people think that they're an inflation hedge. They are in technical terms, but sadly, that has been well recognized, and the prices have been pushed to levels that we think are fundamentally unattractive, and we're not alone in thinking that view. Government bonds, another popular alternative, deemed to be safe, yet sadly, in this complex world, we're worrying more than ever about sovereign risk, with the likes of Greece and the other club countries being the latest generation that concerns us. But we're also worried about prevailing bond yields. We've had a 10-year bull market in bond yields, and given the inverse relationship between prices and yields, you buy today at low yields, you risk a capital loss as yields rise and your prices fall. So what is the solution in this world? Well, quite simply, equities have a very, very powerful place, a very powerful role to play, and they've got a number of inherent attractions as well. The right kind of company will survive in any kind of environment. We recognize that. But crucially, the right kind of company, the right quality of company, can also make you very serious money. And I use the example of Nestle, which delivered fairly modest compound growth in sales, a little bit of extra profit, and thanks to the combination of that, plus a small element of re-rating by the market, a holder over the last 20 years would have made 11 times their money. Now that's not bad. That's good inflation kind of hedge. Crucially, there is a very good backdrop for equities in place thanks to the nascent but fairly persistent global recovery that's underway. And valuations look attractive. We often talk about the PE on which markets stand. They don't look, those sort of valuation measures don't look particularly stretched. Dividend yields are quite attractive, especially against cash returns and bond yields. But crucially, I draw attention to the free cash flow yield that's inherent in equities. And that, I go on to say, is actually fueling a lot of the M&A activity that we're seeing at the moment. And that, for me, is very strong de facto evidence that equities are cheap and attractive. Within the subject of equities, I stress quality. I think that provides for durability of returns. But crucially, I also highlight that certain geographic areas are very strong still in their thematic appeal. And of course, emerging markets, the BRIC nations, come very much centre stage. China is the big train there. It pulls a lot of wagons behind it. And I think that story will carry on for a number of years. The story is quite simple. It's one of urbanization. 1.3 billion souls within China, 540 million people in the urban centres. And over the next 13 years, and this is us picking up on work done by McKinsey last year, over the next 13 years, another 350 million people will move from the fields to the cities, will enter the urban environment. It's a lot of extra consumption. But crucially, it's a lot of infrastructure building as well. The space requirements for those people require new cities to be built along the following lines. It is quite simply 50,000 skyscrapers. It's the equivalent of 10 new New Yorks, plus all the ancillary stuff, the mass transit systems, the airports, the subways, the sewage works, etc., etc., etc. Very powerful theme, because that movement is concentrated into quite a narrow time window. 13 years is not long. 350 million people is the equivalent of the population of Europe, the population of the US. I round off my talk by highlighting what impact that has within the commodity space. A very powerful demand story in place because of these urbanization trends, because of emerging markets generally, against the backdrop of the recovery in the Western world. But the other part of the appeal for us is the constrained nature of supply that you get with metals like copper. We simply can't find enough to keep up with demand. That sets the scene for higher prices. Currencies, well, a quick dance through. Basically, we like a number of hard currencies: the Australian dollar, Canadian dollar, Norwegian krona, that are where we have countries with solid financial systems. What we don't like is the major currencies, the dollar being quite typical. This is a factor of the printing presses, the way they've been whirring. The dollar in particular, suffering from twin deficits, looks to us like it has a shaky future. And gold has great appeal. Classically a store of value, for us an alternative currency and a very valid part of the asset allocation mix. So by way of summary, you can have a small element of bonds, fine, but equities have to be the largest part of one's asset allocation as a way of ensuring durability of returns and an appropriate hedge against inflation. Mix in a little bit of emerging market exposure, but be aware that you get a lot of exposure by proxy via companies based in the West. So don't ignore the appeal of Western companies as a way of getting emerging market exposure. Get a little bit of commodities on board, and remember the ongoing appeal of gold. It might have done well, but there's a lot of further upside there. Thank you.